Well, let's get across the market open now. Chris Weston joining us from Pepperstone. Chris, welcome to Tuesday. Good to catch up with you. Now, of course,
Morning.
US markets closed. What are we going to be guiding us today, do you think?
Well, it all kicks off now into September. Obviously, as you say, their Labor Day holiday. We had a partial close in futures. We're open to about 3 a.m. our time. We're not really taking too much of a lead because those volumes were very, very poor. They were about 30% of what we expect in the FX markets as well. So it all sort of ramps up. We've got futures reopening now, and obviously we sort of build as we go into European and US trade, into the cash open, and that's going to be fully reflected now that we go into September. And obviously, there's a lot of people who've been out of the market, probably taking time off in the Hamptons in the US, and some of the big hitters have left the sort of flows to the juniors, and if not the AI systems. And I think that all sort of kicks off now as we go into what's going to be maybe a potentially more volatile and lively September. So I think as we go today, everyone's sort of just getting back in. How the big hitters going to change things, if at all. What are obviously the big event risks for this week? How do we manage them? What's the propensity for volatility? What happens on payrolls? All these factors, and people with sort of massaging positions. But obviously, we've got to focus on the dollar, real rates. Obviously gold's been very much traded. Gold miners have been absolutely flying, as you'd expect. So there's plenty of things going on. I think now it's really sort of just looking at the risks where your portfolios are, and how you like that positioning relative to some of the risks that are coming through in the coming couple of weeks.
Let's just pick up on what we're seeing in precious metals there at the moment. Chris, you mentioned gold. Of course, it has been in that sort of consolidating phase over the past couple of months. Silver also taking off. What do you see as actually driving that at the moment?
The problem with the gold markets, or the precious metals, because this is a precious metals move now. It's platinum's even had a bit of a move up as well, but silver's absolutely gone for it. It's highest level since 2011. Gold's had this kind of stealth, gradual grind higher, but now you're seeing some real flows take place. And I think the problem with the metals market is that you can come out with 10 different reasons as to why gold's doing what it's doing, and it's the thesis behind that situation. But I don't think there's clearly one actual smoking gun that says this is exactly what's driving the capital. I think obviously you can focus on the Powell's testimony at Jackson Hole, and the idea now that they've opened the door to a September rate cut. People are saying, well, there's probably some dollar risk to the downside. That's where the sort of skewed directional risk is, and the dollar's looking pretty heavy at the moment. So I think dollar flows have been one factor. You've got the US real rates complex, which is effectively US Treasuries adjusted for expected inflation over that time. The real returns there, and they've actually been falling very, very sharply indeed. Now, gold's relationship with real rates does come and go, but we have seen a marked pickup in the relationship there. So as real rates are going down, it's pushing gold up, and obviously gold has no yield. So in a situation where the real returns, the yields are falling, it does sort of reinforce the relative attractiveness of gold. You can look at Fed independence, obviously with the Trump-Cook saga going through, and it's really beefing up at the moment. There's been a lot of conjecture from some fairly powerful individuals talking about the fallout if Cook is to be replaced, and Trump obviously stacking not just the Supreme Court but obviously the Federal Reserve as well, and that is a reason in itself to buy gold. But I think yesterday what we saw was quite an interesting dynamic, that we are seeing Chinese traders really coming back in. We saw that in the SFHE futures market, and the spot market obviously also taking some good upside. So it looks like China are back in the mix after taking a bit of a hiatus, and they look like the traders they're bigging this one up as well. And then I think you've got just the fact that it's going up. You've got a lot of momentum-based factors out there, systematic flows. People chasing the upside, the CTAs who are putting money into futures, and as price goes up, they have to be, the rules dictate that they've got to be buying. So I think that's all sort of just cacophony of positive factors and reasons to own gold. And we're very, very small margin away from all-time highs in the spot market. You've got all-time highs now in gold priced in Japanese yen. It looks like it's going to be breaking out to the upside in all currencies. So it's not just a weak US dollar theory. This is actually actual insatiable flows into the gold market. Gold miners are absolutely blowing up. We're seeing better inflows into the GLD and also into the GDX as well, and I think that's probably moving full circle. So a lot of the flow-based effects are helping matters out now. So I think for me, it does feel like a matter of time before gold does trade to new all-time highs, and obviously people are watching what happens on payrolls on Friday. That could be a big kicker for the gold market. But I'll be watching real rates. I think that's a huge story for the gold price there.
Now, Chris, you mentioned there that that US dollar risk to the downside. How's this likely to play out for the Aussie, do you think? Clearly it has struggled for a sustained break above 65.
Well, I think, if you're trading it against the US dollar, I mean, obviously, so much of that is going to be dictated to by the denominator on that ratio. On the relative value there, I think it's going to be driven by the US dollar side, and the Aussie is going to benefit from, if the dollar goes down and you do see some further upside in gold, maybe it's a little bit of upside in some of the industrial metals, ferrous metals, then I think you probably get a bit of a kicker. And 66 has really been, the year-to-date high, and that's the level that people will be looking for in the short term. I think you're obviously looking against the cross rates, and things are okay. Certainly against the Japanese yen, was working quite well, but it's not really a reflection of anything domestic. We've got the further partials coming into the GDP calculation today for tomorrow's Q2 GDP. Net exports as a percentage of GDP, balance of payments. I expect them, regardless of the outcome, come to have absolutely very little bearing on intraday moves in the Aussie dollar. I think you're really looking at what's happening in Chinese equities, S&P futures, and some of the metals complex. But obviously, as we go through the session ahead, I mean, if you are trading Aussie against the US dollar specifically, then obviously you want to keep an eye on some of the data out tonight. Obviously, it does play second fiddle to payrolls on Friday. Which is obviously the elephant in the room. But we've got ISM manufacturing numbers, we've got the S&P global manufacturing numbers as PMIs, and we've got the JOLTS job openings report, which obviously we do look at things like the quits rates and the layoff rates, which have been pretty positive recently. But the market's still really sort of scratching out where growth is. What's the actual real situation with the labour market? Something that could come into power, but obviously, if everyone focused on payrolls on Friday, you'd expect to see, unless you saw a massive surprise or deviation from expectations, I would think the market's probably going to move a little bit on this, but not to anything too substantial, because, as I say, everything in terms of volatility is priced off non-farm payrolls on Friday.